Hi, welcome to the fifth episode of Budget Analysis series. My name is Swapnil. In this episode, I'm going to tell you how to analyze government's tax income. First of all, we have to look at the budgeted estimates, which shows how much does the government think that it can earn through taxes, especially corporate tax, income tax and GST next year. So basically in this budget, what you will have to find out is the growth rate for FY24 tax revenue, which should be in line with the nominal GDP growth projected for FY24. To do this, we usually don't look at growth rates directly because there is a chance that it will give us some very volatile growth rates and can impact our analysis. But it does not mean we should completely ignore it. So the best way to analyze this is to see tax to GDP number. Take corporate tax, gross tax revenue or any mix of taxes and then divide it by nominal GDP. This ratio can be properly compared to previous years. We do this because tax collections are dependent on how the economy has performed. If the GDP is low, there is a possibility that the tax collections are also lower. Therefore, tax to GDP ratio accounts for both these issues and gives us a much better picture. Now this is an interesting picture of tax to GDP ratio. Here we have gross tax revenue to GDP ratio in yellow and net tax revenue to GDP in green. I hope you remember the difference between gross and net tax revenue discussed in earlier episode. This picture tells us that until FY08, our gross tax to GDP ratio was in an increasing trend. In the net tax to GDP, we also see similar trend. It reached its peak at 9% in FY8 and post that it has stabilized around 7% of GDP. However, we saw that gross tax revenue to GDP ratio has increased slightly after FY15, but we do not see similar rise in net tax revenue because of devolution. The government started giving more money to states post FY15 onwards. Therefore, you can see some upward shift in devolution as a percentage of GDP. Now, here's the breakup of gross tax revenue. We see direct tax to GDP ratio in blue and indirect tax to GDP ratio in pink shades. We can see how direct tax relative to GDP rose in the first decade of 21st century and then remained around 6% of GDP even today. Journey of indirect tax to GDP has been quite volatile and completely opposite of direct taxes. Indirect taxes as a percentage of GDP came down post FY08 and then moved between 4 to 5%. Now it has stabilized around 5% of GDP. This is despite the introduction of GST in 2018. Now, where do you find this data? I will write down the path of this file in the description below. Tune in for more videos and follow me. Thanks.